Hello, this is Derek as well, Chief Investment Officer for Shelton Capital Management with another Shelton CIO Minute. In weeks past, we've discussed our bullish perspective on emerging market equities based on the fact that after 10 years of underperformance, they are relatively inexpensive. They have better growth prospects than developed markets, and in this day and age are even less risky than they used to be before. But one of the other points we've also made is a key element to trigger the outperformance of emerging markets is the dollar. In this chart from earlier this year, you can see how a weaker dollar propelled emerging market prices in a positive direction until about 10 years ago, when dollar strength reversed and emerging markets performance weakened for the following 10 years. What we'd like to do today is a little second level analysis to see where the dollar might go from today going forward. Of the primary drivers for the dollar, interest rates across the different currencies and countries across the world are the most important. The top of this next chart shows bond interest rates relative to the US market over the past 2+ years. Emerging markets are at the top, Europe is in the middle, and most notably, Japan is at the bottom. Now, while emerging market and European rates have basically moved up in line with the US as the Federal Reserve has hiked the Fed funds rates, thanks to their policy of yield curve control, Japanese rates remained where they were. So as the Fed raised rates, the gap widened. This propelled the dollar to new highs up until September of last year, when it became clear that due to some inflationary forces Japan was experiencing, the government was going to be unable to hold interest rates down any longer. And they began to ease up on their rate control practices. So relative rates since then have flattened and even reversed a bit. And what we've seen since September is a reversal in the dollar, and now the dollar has weakened considerably. Now, inflation continues to be strong in Japan, at least by Japanese standards. And the conventional wisdom is that they will let it continue. Yield curve control will become less tenable, and Japanese rates will inch upwards, and the dollar will weaken as more Japanese investors are going to be willing to put their money locally instead of offshore. And so with that in mind and relating this back to emerging market equities, we expect to see continued dollar weakness, and as a result, hope that this catalyst for emerging market equity performance will continue. Thanks for your time, and for further details, please contact your local Shelton Capital representative. This has been another Shelton Capital CIO Minute.